if you're evaluating properties and trying to figure out what kind of decision you want to make, it's an interesting piece. It's like, and maybe why we see more flips in California than the buy and holds, right? It's like, what's the local cap rate? What's the local legislation?
Of course, if there's an alternative, I'll go into the rates. And for us, it's risk-based pricing. So where are we getting that return? How do we get a return on our cap? We're a balance sheet lender, typically, right? So, I mean, how much more risk am I taking than a CD at 5%? And it's the same everywhere. Where can you put your capital to make it work? And this industry has become so, it's becoming very standardized.
JMJ Financial, the podcast.
So, I mean, we're probably at a floor rate right now of 8.99 for that well-experienced fix and flip guy. And then 8.99 being the floor. And it's kind of what do you want? What's important to you? Are you going to have it for 12 months? Do you want the 8.99? Or do you want to maybe pay a little bit more in points for the 8.99? Or you're not so concerned about this, you're going to be in and out. Maybe you want lower points and a little bit higher rate. So, we can kind of customize that. Not really tied into anything like you guys are in your world.
Yeah, the risk-based pricing, that's how conventional and most mortgages are done, right? That's why if you're buying a condo, a lot of times the rate can be a little bit higher. If your FICO score is worse, the rate's a little bit higher. What's interesting is, you talk about it doesn't change as much during COVID times when we're selling 2% rates, but it was still about 10% in private money, right?
Yeah.
And just a few months ago, maybe a year ago, we saw 8% rates and you were still 10%, right?
Yeah.
So to me, it says that, the people that are putting their money into private funds to lend out, a lot of it's opportunity, right? If they think I still want to put it here because if I put it somewhere else, I like what real estate is doing. So that's just really saying they like real estate. They like the asset class compared to stocks or something else because maybe it's a long-term vision of how it's going to perform or just the reliability of it. And because otherwise, I feel like you should see a difference when the market moves and there's other opportunities for investment.
Yeah. I will say, going back to COVID, rates on the fix and flip, everybody they got kind of sketchy. Nobody knew what was going to happen. Nobody knew if these loans were going to perform. Nobody knew if there was even going to be a market on the exit. And a lot of people tried to slow their lending down on the private money side. And rates went up into the 12. And you saw lower leverage and just everybody became risk adverse. Where you guys were seeing the 2% rates, we were seeing they did go up a little bit. But yeah, I mean, there's so much capital in the space. You talk about somebody that wants to invest in. We have a private mortgage fund. So we take investors in, all accredited investors, and it's not more than 10% of their total net worth. And they're representing that they're an accredited investor. They've got over $1 million in assets, and they make over $250,000 a year. And they've got some understanding of the way it works. So they're investing and they're taking that risk. And I invest in my own fund too. So it's not all the eggs in that basket, but it's a nice way to get a good yield. And if you're in a private mortgage fund, what you can't do in the stock market or you can't do with an annuity, you can reinvest. So reinvest your capital account, you put in 100 grand, 12 months later, you're at 112,000 and that's compounding and you can just reinvest that. It's a great tool. That's for the private investor, the guy that wants the mailbox money or wants to invest in this class, but doesn't want to swing hammers, doesn't want to fix toilets and stuff. The other side of that is there's so much institutional capital in this space. And I know you guys, I don't know if in your space, do you guys have the Lifecos invest in mortgages on the back end?
I don't think so.
I don't think so, yeah.
Yeah, we've got, it's become, on the DSCR, there's Lifecos now, there's the big hedge funds, and they have carved out a piece of their capital for this. The Lifecos are coming in now, and they're causing some of that rate compression. For a guy like me, I'm getting way into the weeds now, but for a guy like me, I can write a loan, like the last one we did together, and I can take it, and there's an intermediary that runs the capital for the Lifecos. and that intermediary underwrites. I underwrite, the borrower underwrites, it goes to this intermediary, they re-underwrite it, and the life co's gobbling it up, and they're not looking for a 10 or a 12. They want, this is their yield. So they'll buy that note, that intermediary gets a piece, I get a piece. It's like this whole, it's basically a rebirth of the mortgage-backed securities. Those mortgage-backed securities that went away after the subprime meltdown. They're all in this. All those same players are in this.
Interesting.
Yeah.
The piece about during COVID and the uncertainty, I think it's an interesting piece for just the average consumer who is trying to figure out where is the market going, what's going on, and the importance of leveraging somebody who is in the industry, because during that time, like you're saying, people were looking ahead and saying, I don't know what's going to happen. We're going to pull back on the kind of product we're offering. And we saw the exact same thing, right? Non-QM, being your bank statement and DSCR loans, evaporated overnight.
Yeah.
And as a loan officer, it made it kind of nice because we're like, 30-year fix, 30-year fix, 30-year fix. Like that was the best available and easy, where now I think that people are opening up the credit box. They're more optimistic, and we have so many products that we're able to offer, right? It's much more complicated to quote somebody because there's 20 things, not just one thing.
Yeah.
So I see being in the industry and seeing like what people are offering is an indicator of maybe the strength of the economy and the health of the real estate market.
Yeah. It's a stable class.
Yeah.
And you guys know it too. I mean, we've got a housing shortage. So I think everybody could go long on this, but I'm like, everybody's speculative that real estate will be stable. There's little peaks and valleys. We talked earlier about other states and a little bit of market volatility in real estate, but for the long haul, everything goes up and to the right, right?
Mm-hmm.
Yeah. In real estate.
Yeah, it's interesting. That's a good point, Mike, about all the different products. Because if anything, it almost seems like your traditional, government-backed, conventional FHA and all that. That's what's more volatile now. Whereas some of these non-QM products are a bit more stable. And in certain instances, you got a really well qualified borrower, whether they're an investor or buying, let's say, a primary with like a bank statement loan or doing a DSCR. The rates are really, really close to if they were just a standard W-2 conventional buyer.
Yeah.
Yeah, it's
with an easier process, hopefully.
with an easier, oftentimes an easier process. Yeah, definitely easier with if they have experience doing a DSCR loan.
Yeah.
It's almost no documentation whatsoever. And then, same with your self-employed borrower who's concerned, like, oh, I have to do a bank statement loan. Well, if they have a decent down payment, they might be getting pretty close to the same rate they would have been getting anyway.
Yeah.
Yeah, it's interesting how there's been that shift.
Yeah. Yeah. Do you guys do a lot of DSCR loans, or?
We have quite a few options. I personally haven't really dabbled too much in that. I've done a number of bank statement loans for borrowers. Mike, I think you've done some DSCR, right?
I'm working on one right now. Yeah. It's less common in California because of the cap rate.
Mm-hmm.
When you have to have such a large down payment to make that ratio work, and there are options available to take lower ratios essentially, or to not have as good of a ratio, but they aren't as priced as well, so they often just get priced out. So I got a buddy who only does DSCR loans, and most of what he's doing is out of state, because that's, I think, where they predominantly are. With the DSCR stuff, it's nice because there's no income documentation, right? But for a lot of the programs, I'll say, you're just dependent on what the appraiser says the rent value is. So you go in with this question mark of like, yeah, we think it's this. We're hoping for the best, right? So there's been scenarios where I'll lean towards a bank statement loan because it's like, we underwrote it. We know what it is. We're good. We don't have to worry about what happens in escrow.
Yeah.
So,
yeah, escrow meaning like the process of verifying rents, and yeah, DSCR is, and we do, until my mouth is dry, I explain like all the risks. That's a common risk with the rent, and we look at Rentometer. We have all these tools, and we try to figure out what that fair market rental value is, or designated property income, and it's up to the appraiser. to go out and give us that verification. I have a story that we're closing this loan today, but I mean, borrower's in San Diego. He's got a phenomenal schedule of real estate. He really knows what he's doing. Found a property in Texas, and the in-place rent is $3,900 a month. So we price this, and I give him his coverage ratio is over 1.5. The debt
which is really good.
which is really good, right? It's the debt on this versus the income, he's cash flowing. And with his imputed equity, his down payment, all his costs, he's like 20% cash on cash. And these are the things that I always go through with my borrower. If they don't know, then I'm going to point it out to them. Look, you're making 20% cash on cash. You're making 2%. Do you want to do this deal? Like, I don't want to go through that process. And they go, well, wait a second. I'm putting in $100,000 and I'm making $2,000 a year. California, you might do that out of state. But that story is these designated rents were $3,900 a month. The in-place rents, legacy tenants, he's buying the property with these tenants in place. He's going to cash flow. The appraiser goes out and says, designated rent's $2,600. Even though everybody there is paying $1,000 a month for rent, we think it's $675 a door. We're like, we're dead in the water. And you battle and you do everything you can to get that appraiser. These are the other market rents. Like, and why are they paying $1,000 a month if it's $675? Why would anybody in their right mind do that? So yeah, you're tied. You're stuck with that. And that's where, that's probably something I should talk to you guys about and flip it over to you guys, and you guys do a bank statement loan.
Yeah. I think, so with DSCR loans, and just talk about investing in general. So around here, you're 40% down if you want a cash flow positive.
Yeah.
At least probably.
At least. Yeah. So curious to hear what you see, but what I see is that, at least in our market, I think in other markets as well, it's really tough to do a minimum down payment, even if you're getting a conventional loan and your payment's lower because of the rate's lower, and cash flow positive. If you're just going to go buy a house with 20% down, you want to rent it out, like that doesn't really work anymore. You have to be doing something. You have to be doing it as a short-term or mid-term rental. You need to be adding value with improvements and renovations. You have to be renting by the room. I'm curious if you agree with that and if you've seen anything that you find interesting.
Yeah, no, you're right. In California, that all goes back to the stuff I was saying earlier. Like, what's our average sales price in California? $750, something like that. You guys probably know better than I do. But
that's fair,
about that. Yeah.
So you put down 40% and you're making no money or you're breaking even. You've got $300,000 in that deal. I would rather go put $300,000 in a CD or in a private mortgage fund and compound my income. The only offset on that in California is house price appreciation. In other states, we do a ton of stuff in Ohio. And we'll test, and I go, this is a 50% cash on cash. You're making 50% on your down payment. Imagine that in California. That would be freaking insane. Plus house price appreciation. It's just not heard of. So Ohio is a really good market for that. Texas, this deal we were doing there, he's still going to make that money. We went back and battled everything on that deal. We had to correct taxes. We had to battle the appraiser on the market rent. And you guys know how that process goes. We can't go to the appraiser. We got to go back to the appraisal management company. Mm-hmm. Then they go back and then they scope it out and go, well, we don't like the way you worded your request for a new value. So you go back and do this again, and we go back and battle. But you're stuck with that. But Texas is good. Georgia is good. Florida is still cash flowing. Ohio, Pennsylvania, this is where people are going. But you talk about what you can do to the DSCR loan it has to be rare. It can't have more than between the programs are $2,000 in deferred maintenance, or required repairs. It has to appraise as is, not subject to. So if it needs any repairs, then it's where the bridge loan comes in with the renovation. And we can go, okay, we'll finance 80% of the purchase like you were going to do, and we'll finance 100% of the repairs, get that property back up to market value. Minimum repairs are $10,000 in that loan. And then, the borrower can come back and try and get their money back out on their refinance that Did we talk about the BRRRR?
We haven't gotten into detail
We
on
haven't
it.
gotten into detail, yeah, if you want to touch on that, but
I hope this isn't the Kip show. Like you
well, I mean, that's why you're here. So I don't know. It's to highlight you, but
okay. So, I mean, the BRRRR is that perfect situation for the guy that says, "Okay, I've got a fixed amount of money," and you've probably heard this same thing from your Bigger Pockets podcast, and they're the ones that invented this act. So, but they've got a fixed amount of money, and they want to scale. They want to buy rental properties, not property. So they're not going to park that money and get a cash on cash return. They want to put that money into the deal and get the money back out of the deal, plus the appreciation, maybe a little bit of that appreciation, the equity that it's appreciated.
mm-hmm.
So they got a fixed amount of money. They buy a property, they renovate the property, they rent the property out, and then they refinance, and hopefully it's come up to, they bought it right below market value. They've improved it, and now it's got appreciation, and it's worth what everything in the neighborhood's in. They get their money back out on that refinance, and then repeat the fourth R.
Right. So once again, it's so dependent on what state and the market, because I haven't seen it in California, just because you could only maybe do a 60% cash out to still be cash flowing on the property. And I think it's actually more of a growing trend where people just don't actually care. They just want the property. And even if you're breaking even on it between your mortgage and other expenses, you're getting the great appreciation on it, which is really, at the end of the day, a really similar strategy to what flippers are essentially doing, right? They're banking on forced appreciation, and if you're buying and holding with little cash flow, you're just doing market appreciation.
Yeah.
In a market that appreciates a lot, right?
Yeah.
So
yeah, I mean, it seems like in California, at least, just kind of bringing it back to investors and experience and all that. Like you got to really have a keen eye for finding a good deal in order to be profitable, especially if you want to hold the property. You know, like Mike was saying, we got to have a lot of capital on hand, and then obviously have the whole thing make sense. So it's almost I don't want to call them unicorn properties in order to make all this work and complete the whole thing and refinance it and hang on to it, but it's definitely more difficult to swing in California, it sounds like.
Yeah, and it is a unicorn, I think.
Yeah.
There's, you find a distressed property here, and you go, sorry, let me mute that.
We'll edit this out.
I should have just turned the thing off. If you find a distressed property here, and everybody, it's just we're so real estate centric in California, and especially Orange County. Like, how many, you can throw a rock and you're going to hit 10 realtors and 10 lenders and 10 construction guys. Everything is around real estate here. So when you do find that deal in let's say $1 million neighborhood, and the formula to buy right is 65% of the after repair value, and you can pick it up, and they list it at $599, and they're expecting it to be bid up to $650, and maybe that's your cap, right? Investors come out of the freaking woodwork, and they're all after that property. They're all chomping at the bit, and everybody's going, that's the formula, right? 65%. I can buy this property, fix it up, refinance, get my capital back out, or I can flip this property for $1 million. But there's a line out the door. I mean, that's still happening now with the way rates are now in your world. People are still lining up out the door, and the investors are going, this is a good deal, and I can take this property and renovate it. But somebody might come in and go, you know what? It's livable. It'll finance. This will pass an appraisal, and I can buy it, and I'll pay $850, and then I'll do the repairs and hang on to the property or move into the property. So you've got all the investors lined up out the door and the homeowners. Everybody's chomping at the bit. It's tough to buy right. It is a unicorn, and then when that unicorn shows its head, everybody's, yeah, we've seen the unicorn before, and here's what I'll pay. I'll pay all this. It just gets bid up.
Yeah, it's like the secret's out. Thanks HGTV, right?
Exactly.
Yeah. They know that you can do really well, and hey, surprise! If you buy a house in Newport Beach, it's going to appreciate, right? It's not a secret. So it's like getting back to, you have to have some unique strategy or being in some type of a different market. We did one, I think last year, where it wasn't LA proper, but just outside of LA in an area that's still nice and appreciates. And it was like did great, right?
Yeah.
Yeah. What else was I gonna say about that? Other than I think getting back to the unique strategy part too, right? So move-in flips, I think, is probably a more sustainable way. If someone's never done it before, as we've talked, there's like so many variables to get into it. So just buying your first property, living in it, you can renovate it, and then decide if you want to sell it or rent it, and then you go buy another one to live in. I feel like for the average person, that's really where real estate investing is, because it's a lot to just jump in and say I want to invest and compete with all these other investors, especially in a compact market.
Yeah. Yeah, and if it's funny, I mean, I'm sure we've all done it, right? We've all bought a home and fixed it up, made it, customized it, or added on, or added an ADU. That's what I did on my place. And you go, I've got this experience, and then they come to me and they go, hey, I want to do a fix and flip property. I found this deal. It's a good deal, and I go, it's FICO and experience, right? So which FICO? I got an 800 FICO. What's your experience? Have you ever flipped a home? Well, I've done the move-in flip. I can't count it because it's been their primary residence. It's a great strategy for the experience for the borrower to go out and do it on a fix and flip property, but I can't count it towards experience on what was bought as an investment and sold as an investment. So it's good experience, but it's tough in my world because I don't really count that because it was their primary.
Well, it's just so different, right? Because if you're living in the property, you have your mortgage that you were paying anyway.
Yeah.
Where if you're
It's less
doing
risk.
yeah, if you have your own mortgage plus you have another property with a mortgage, and every month you're paying that 10% or so rate on it,
Yeah.
and plus whatever other fees and tax and insurance that go with it, time is money on it. So I think that maybe is what it comes down to, is you don't have a lot of leeway for making errors in the trial and error piece when it is a true flip in a property you're not living in, because every month you're holding it is killing your bottom line.
For sure. Yeah. No, you're right. Time is money. Yeah, you buy those, and that's the other part of a tough fix and flip in California. You buy a $750,000 property or $1 million property, and the 1.7 is actually the example I gave. That's a deal that I'm doing in Huntington Beach. And that's a tough nut. It's over 10 grand a month to debt service.
Yeah.
And you're going, this thing has to go full throttle. You're there every day going, okay, let's go, guys. Like,
Yeah.
whip driving that deal.
I think that's one of the reasons why, especially if it's your first, just pairing with somebody who's done it before is so important. I got a call yesterday where somebody was just trying to build an ADU and the contractors walked out on them after taking the deposit. And it's like, oh, we have the original mortgage on the house plus a loan for the ADU, and now we aren't done, so we need more money. And
Yeah.
I'm just like, good for them for trying it and being aggressive, but I think that a better strategy would have been to partner with somebody who's been there, done that.
Yeah.
And really the construction piece it's so variable, right? That's the tough part to get right.
Yeah. Yeah, for sure. I mean, yeah, there's a lot of things you can do to protect yourself. I hate those stories of the contractor walking off the job. That's brutal. And but yeah, if you've done that and as a homeowner, if you've navigated that process, then I think you've got a leg up. Even if you haven't done your first fix and flip deal, then you've got a leg up on dealing with the contractor. You've got the scars from what happened. You're going to do things a little different this time. It's still a good experience, for sure.
We talk about that a lot, right? Buy your own house first, please.
Yeah.
Yes, that's usually a good strategy.
Yeah, for many reasons.
Yeah.
I agree 100%. And I think I've got a little video somewhere on the internet where I'd say that's how you build legacy wealth. There's so many good things about buying your primary, owning your primary. And it's so strange. I've even seen, like, I don't know if I should say who he is, but I've seen an Instagram where the guy's like, why would you buy a house? Why would you buy your primary? It doesn't make you any money.
Does his first name start with Brandt with Brandt?
Last name starts with a C.
Yeah.
It's funny. I mean, that's where, let's talk about like where capital comes from for a fix and flip deal, right? And I talk about this and I go, you guys are probably way better at this than I am, but like, why would you want to own your primary residence, right? You're rooted in the community. You've got a fixed payment for 30 years. If you're renting, your rent's going up possibly every year, 20%. Your kids are going to the same school. It's It's the American. Everybody should own their own home. And then what happens is you're paying that mortgage down and you're getting HPA, house price appreciation. That's your number one thing to go leverage responsibly and use that money to make more money. That's a smarter thing, in my opinion, to leverage your primary residence. Go get a second or refinance, do a cash out refinance, tap that equity, use it responsibly, and go buy something that's going to make you money, a fix and flip or a rental property, or do the BRRRR, versus taking that money out and putting your kids in college. Like, take that money out, go buy a rental property, go do the fix and flips, and take that profit and send your kid to school and keep turning that money. You can't do that if you don't own, that's the number one source of capital, is a little bit of equity from your primary residence.
Yep.
Yeah, I mean, it comes back to, the hardest part with real estate is getting into the game.
Yeah.
But once you're in, it just opens up so many potential opportunities for you to continue to invest, and that's a great tried and true strategy that many people have done. It's that, again, there's not really any way to save that kind of money, because you have such a, you already have an expensive asset that's, even if it's gaining at like a smaller percentage because it's worth so much, it's the amount of money that you can tap into after a few years. It's pretty amazing.
Yeah.
Yeah.
And I loved what you said about all the other factors of like, hey, we're still living life, right?
Yeah.
We did a podcast episode recently where there was a survey done on top reasons to buy a house, and the financial benefit was number 4, and the first 3 were all lifestyle reasons, essentially.
Yeah.
And I think it just goes to show that. So I asked Jason Thibodeau, do you think this is because of a lack of education of how great it is financially to own a home? Or is it just because there's more important things to most people than just finances? And, we don't have an answer for that, but I suspect that it's the latter, right? Is that people want to live life happily. And owning a home provides a lot of opportunity for various things in that category. So.
Yeah. Yeah, I don't think there's enough focus or education on it. It's coming from us. Coming from you guys, really.
Mm-hmm.
Like what the benefits are. I mean, we've got the government agencies that promote home ownership, but really everybody should talk about the benefit of homeowner and get into that property, right? Like on your primary, you guys take gift letters, right? And or there's grants, or there's down payment assistance programs. There's all those programs, but you get in, and then you scale up. If you buy that condo, you buy the starter home. So many people, I think, get in that mindset, like, I have to save up the money before I can do this. How hard is it to save up $100,000, $50,000? Like, how do you do that? If you're a W-2 employee, you carve out a little bit of money and you park it in the bank. It's going to take you a long time to get there. You have to find a way to get that financial assistance from family, from grants, down payment assistance. Buy the home you can afford. Buy a little bit lower home than you want, and work your way up to that. The same thing with fix and flip loans and DSCR loans. Like, DSCR is a little bit more rigid lending. It's a 30-year product, and it's very, very institutional. But for a fix and flip loan, I tell borrowers this all the time. We get a lot of borrowers from Bigger Pockets, and I tell borrowers this all the time. Like, they're like, "Oh, I'm going to start saving my money for this." I'm 6 or 8 months down the road, and I go, "Is there somebody there? Do you have a rich uncle? Can your parents write you a gift letter? Do you know somebody that's doing this? Can you partner with somebody?" And then we get into like how they can partner with somebody, how they can take capital from somebody else, still be the sponsor, the borrower, the guarantor on the loan, but capital comes from somebody else, either a joint venture agreement or a gift letter, or members in the LLC, and they've got they're signing on the loan too. But where there's a will, there's a way, I guess, is the conclusion.
Yeah, I mean, it's a great point. I think that's something to be said about, you don't think that you can't get into it just because you personally don't have the money sitting in your account right now.
Yeah.
If you have a decent network or family or anybody that can potentially help out and see your vision and where you're going with this, and they're willing to back you. I mean, there's, the best time to get in the market is
now.
It's always
Yesterday.
now.
Yeah.
Because again, you can sit here and try to save slowly, like you were talking about, setting aside $1,000 a month, whatever you can save every month. In the meantime, the market's not waiting around for you, and it's only going to get more difficult as time goes on.
Yeah.
Yeah.
I love two things that you said about, in short, you got to maybe get creative, right? There's lots of ways to go about buying your first house and even doing your first investment property.
Yeah.
And then also the piece about taking it slow. That's kind of my shtick with real estate, is that people get priced out, not necessarily because the market prices them out, but their lifestyle prices them out. Because when you're a single dude and you don't need anything, you could sleep in your car if you really wanted to, right? You could totally buy the one bedroom or a studio and maybe even split it with your buddy. A lot of times you're doing that anyway. You're just renting, right?
Yeah. Yeah.
It gets tougher when now you have a wife and two kids and two dogs, and it's like, well, we need a 4-bedroom place and it's $1.2 million, and you're just out, right? So I was like, get in earlier in life,
Yeah.
and that'll set you up for the future part. And relative to investing, it's like, do your first deal, get some help. Don't go down to the studs. Find something that
Yeah.
needs something cosmetic or that has a limited scope with little risk. And even if you only make a small amount, you get the experience, you get a little bit more capital, you go do it again.
Yeah. Absolutely. Yeah. I hopefully I've said this to you guys too. If I'm anything, I should be consistent in what I tell people, but that's it. Like people call me and they go, "Hey, I found this property in Cleveland, Ohio, and I can buy it for 75 grand. And if I put in 150 grand, it'll be worth four." I'm like, "This is your first deal?" Like, I would steer away from that. And I've done hundreds of these things.
Yeah.
And I'm like, no way. Like, just find the deal that needs the carpet and the paint. Find grandma's house. It's got the stained carpet and the wood panel walls. Redo the drywall, redo the flooring, bring it up to the neighborhood and sell it. Start easy.
That's actually an investor I work with. That was his last project, was partnered with brother-in-law, worked out lump sum payments so that the brother-in-law could continue to live in the property. He works on it. They're going to split a little bit of the profit. And it's like, you actually didn't need a loan from me. And, you cut down on costs and risks and a whole bunch of other stuff just by going to the people you know. I think it's funny that people say you don't want to mix business with, you don't want to mix business with personal stuff.
Yeah.
And I'm like, so you want to work with people you don't know, like, and trust?
Exactly.
So I understand the reservation about it, but the question that I would ask myself if I was going to partner with somebody is, if and when things go awry, do I just trust this person to do the right thing? And then if I do, then yeah, that could be a great partner for you.
Yeah. Even start tiptoe around that too, right?
Mhm.
Don't go buy a property and put in a couple $100,000 each. Buy something that's needs a little bit of that, little bit of work, and you guys are bringing a little bit of capital together. I can tell you, I've got like 2 stories I'm loading up in my mind right now. If you guys want to go war stories, if I can do war stories, but like, partners, you got to trust that guy. I would even take it a step further. If you might not know the guy next, right? You might not know that someone's got, or that they just don't pay their bills, but they've got the money, and those are things that could come up. This is good advice for this podcast, right? Like, trust but verify.
Yeah.
I have a property. We sell bank-owned properties. So, and a lot of the bank-owned properties nowadays are busted deals, busted fix and flip. And far into this deal, I should go. the guys that lost it, they respectfully misplaced their donkey. It didn't work out, and they lost, and the bank took it back. And we went to sell it, and there's an IRS, and one of the guys had problems with the IRS that dated back to like 2016. And the IRS found this property that he owned with his partner, his buddy, and the IRS liened it. That's the worst nightmare.
Yeah.
I think that's fair. I think we've talked about how desensitized we are to talking about people's personal income because of this job, right? And it's just like, hey, if we're going to do this together, let's just put the cards on the table, right? Because I don't necessarily need to change my opinion of you as a human, your ethics and all those things, but I would like to know about your finances.
It's assessing risk.
That's something that can be easily overlooked if you don't know what to look for too in potential business partners. Oh, I didn't think to ask him if he's got an IRS tax lien, and that can be really devastating. Yeah.
I would be remiss if I didn't point out that in private money lending, I mean, this is, like I said, it's all become, it used to be a handshake on the golf course, and it was, yeah, you're going to buy that property, and you're passionate about this deal, and oh my gosh, I'm going to make so much money, and Somebody goes, you know what, I just need the money. And somebody goes, I'll loan you. And it was a handshake deal. And then somebody got burned. It's just like everything else. It kind of just, all those scars become, then there has to be mitigants around that. I learned from that. That's not happening to me again. So then it became, this guy's not paying me back. I got to foreclose. So let's run credit. And credit's one thing. We take it a step further than you guys do in your world. We do a full background. So if I look up Jason Thomas, I'm going to find your neighbors, your family, your LLC, if you have one, everything going back to when the Mayflower landed. So if a borrower came to me and said, you two come to me and say, hey, we're going to buy this property together. We're both going on the loan. Or, you know what? Jason's going to guarantee this loan and Mike's on the LLC. Only Jason's going to sign. I'm going to run background checks on both you guys. And I'm going to search for liens. I'm going to search for affiliated businesses, real estate owned under those businesses, foreclosures, bankruptcies, judgments, liens, everything. It's a good way. If you're going to partner with somebody, go get a private money loan. Don't just put all your capital together and let that capital provider underwrite both of it.
It may sound intimidating, but landlords are doing that. There's a lot of really accessible services that when you apply to rent a place, they're doing a lot of what you said.
Yeah.
So I think that in life, we're just upfront and honest. It goes a long way, right?
Yeah, I mean, yes. It's at some point the truth is going to come out, so to speak, and it's the same with this.
Yeah.
You can sit there and like, oh, hopefully they don't find out about that. No, they're probably going to find out about that.
Yeah.
There's no secrets in mortgage.
It's gonna come back to you at some point, and it's gonna be more painful if it's later than versus now.
Yeah. Do you guys have that conversation? I'm sure, like, hey, tell me everything, right? It's on the application. They check the box. I don't have judgments, liens, bankruptcies, foreclosures, short sales. You guys go over that verbally, I'm sure, too, right? Like,
yeah, I mean, a lot of it too is obviously they're answering the questions on the application, so we are trusting that they're providing us the information.
Yeah.
I mean, sometimes borrowers just don't even realize what they're marking off.
Yeah.
Like, oh, yeah, no, I'm not a party to a lawsuit. Oh, wait, I forgot. My family member just filed a lawsuit against my husband or whatever.
Yeah.
6 months ago. And that includes me because it's tied to the property that I'm trying to refinance. They don't think like that.
Yeah.
So part of it is, and of course, as a loan officer, if I don't know that situation, I don't even know to ask that question, right? And it's just, it just comes up when it comes up. And then it's this whole thing. But yeah, I mean, if somebody knows that they've got a tax lien or this or whatever, it's important to know. And there's only so much that we know to ask if they're not providing all the information to us.
Yeah.
I feel like after doing hundreds of loans, you see things and you're like, oh, I don't want this to happen again, so I'm going to try to be proactive.
Yeah.
So you got to balance that with the client experience, because you don't want to scare people off. You don't want them to feel like you're playing 50 questions and they're like, I got a 800 FICO score, bro. Like, why are you giving me such a hard time, right?
Yeah, that's the biggest defense, right?
I'm trying to do my due diligence, but so it is a balance, right? But
it's a balance, and like I take the approach too of like, hey, look, I'm not trying to rag on you here. If you've got this going on, like, yes, as a lender, we need to protect, the lender's interest, but I'm also looking out for you too, because this is going to potentially cause a bigger issue for you down the road that I don't want to see happen to you. So let's just get it all out on the table now.
Yeah.
And then with that information, let's see what we can do with it.
Well, in our world, there's much less discretion. There's guidelines. You meet the guidelines or you don't meet the guidelines, right?
Yeah.
You may have a little bit more discretion, but
a little bit more. There's things I just can't get over. Like, if somebody's got tax liens or unpaid taxes or judgments, or we look at criminal and it all comes out. And we can be forgiven, like a little bit of discretion. There's certain things we can't get past. If somebody's got a judgment in a lien in another state or another county, we can paper that. We can get over that. But yeah, it's not. We're probably aligned a lot like you guys on some of that for sure.
I think we've been chatting for quite some time here.
Yeah, we can wrap it up now.
What you got to wrap it up?
Yeah, so Kip, I know we've kind of touched on how to get into all this stuff, and when it comes to investing in fix and flip, if you want to just like really condense it here at the end, what would you recommend to a newer investor that's interested in this? And maybe also give us like your ideal client.
Okay. I would say for the aspiring real estate investor, have your capital. Find out where your capital is going. You're going to qualify if you've got no experience. You're going to qualify on your FICO and the capital you're bringing to the deal. So we can get you a loan. We can go down to 600 on FICO, but you have to bring in the difference. So it's lining up that capital, whether that's a joint venture agreement, a gift letter, friends and family, additional members in your LLC. Like, find the capital, and then I think it's getting the education from the podcasts and all the resources out there. There's a ton of it. I would say, and I tell this to everybody on a daily basis, don't get into analysis paralysis. And I talk about like experiential learning. Experiential learning is just get in. Like you guys are saying about owning your own home. Just get started. Like find the deal. Maybe it's a little thin, but you can do the carpet and paint and get out of that property and make a little bit of profit after the debt service, and talk to a professional. I think that's my advice for the aspiring newbie. My ideal client, I love the newbies, and I love having those conversations and educating somebody and watching the success. That's amazing. The ideal client's the guy that's done 3+ and he's got everything's buttoned up. He's 700 plus FICO, and he's cranking them out. He's turning them over. He's just rinse, repeat. Just keeps that recipe going. That's the ideal guy for us. That's the guy that I want to get in my system and get my claws in the guy, and he's not going anywhere else. Like I don't want one of the big box lenders to find and try to underbid me. I'm going to give a way better customer experience to both parties than any big box lender.
Perfect.
Perfect. Yeah. Well, Kip, it's been a pleasure. Thanks for joining us.
Likewise, thanks for having me.